When is inheritance tax due on farmland? Have you ever wondered when inheritance tax is due on farmland? This is an important question for many families involved in farming. Understanding the timing and rules can help you plan effectively. Generally, inheritance tax on farmland, also known as estate tax when property is transferred after death, is due within 9 months following the death of the property owner. However, there are special considerations for farmland that can change this timeline. For farmland classified as active from assets, the executor of the estate may have options to defer paying some of the estate tax. This deferral can extend the payment period up to 14 years. During the first 5 years, only interest payments are required. After that, the principal is amortized over the remaining 9 years. To qualify for this option, at least 35% of the adjusted taxable estate must consist of active from assets. If the farmland is no longer actively farmed, such as being rented out without the owner's participation, the estate may not qualify for this deferral. Valuation of farmland is another key aspect. The Internal Revenue Code allows qualifying farmland to be valued based on its agricultural use instead of its fair market value. This method can significantly reduce estate tax liability. To qualify for this special valuation, the farmland must make up at least 25% of the estate's total value. Additionally, farm assets must account for at least 50% of the estate value. The farmland must have been owned and actively farmed by the decedent or family members for 5 of the 8 years before death. It must also pass to a qualifying heir, usually a family member. Another important factor is the federal estate tax exemption amount. Currently, this exemption is $13,600,000 per individual. However, it is set to decrease to approximately $7,600,000 starting January 1, 2026. Estates that exceed this exemption amount will face a 40% federal estate tax on the value above the exemption. Many farm estates may surpass this threshold due to rising land and equipment values. In addition to federal estate tax, some states impose their own estate or inheritance taxes. These state taxes can vary widely, so it is essential to consider state-specific laws when planning your estate. For those involved in farming, working with estate planning professionals is highly recommended. They can help ensure that farmland qualifies for special valuation and deferral provisions. This planning helps preserve the farm for future generations while managing tax liabilities. Proper documentation of ownership and active farming activities is crucial to meet qualification requirements. With the upcoming reduction in the federal exemption, proactive planning is vital. Strategies such as trusts, gifting, or other tools within wills and trusts can help minimize estate taxes. Executors should also be aware of the option to elect deferral under the Internal Revenue Code to avoid the forced sale of farmland shortly after death. In summary, inheritance tax on farmland is generally due within 9 months after death. However, special rules allow for deferral and favorable valuation, easing the tax burden on farm families. Meeting specific criteria related to active farming and ownership is essential, making timely estate planning a key factor in maximizing these benefits.